Audio Jungle. Audio Jungle.
Stocks are a notoriously difficult to navigate market. I mean, बंदा एक नियत से जाता है और आगे इतने रास्ते निकल आते हैं कि समझ नहीं आता करे तो क्या करें. And while there are many things that cause this confusion, by far the most fundamental one is the difference between the two types of stocks, growth-based and dividend-based. And the reason why this is so important is that even if you have a basic understanding of the difference between stocks, you can still lose money by not knowing the difference in which they behave, what they tell you about a business, and what kind of strategy they go best with. But isse pehle ki you start to lose hope, we're here to help. In fact, in this video, we're not only going to be talking about exactly what the two types of stock represent, but exactly how a seasoned businessman may use them to his advantage. And if you watch till the end, we'll reveal a simple rule that can make or break your attempt to make money through stocks. So without wasting any more time, let's jump in. Now, as we mentioned at the start, the stocks are generally divided between dividend stocks and growth stocks. But apart from the absolutely basic differences between them, no one really knows what the two kinds mean. And even if you go around trying to find out what the market strategies for the two are, आपको उसमें भी हजार opinions मिलेंगे. And by the end, you might end up more confused than what you started out with. But as it turns out, you don't need to go into that much depth anyway, as all you need to know are a few simple differences and maybe a couple of clever pieces of advice to know exactly what kind of stock is right for you. And the first of those differences is just that no stock is superior. As a team of businessmen ourselves, we at Omega Finance know the temptation of trying to find the quote-unquote best kind of stock. And I wouldn't be surprised if you people have also searched things like, are growth stocks better or dividend stocks? Or something along the lines of, which kind of stock is best? And while both of these questions are good, there's one major problem with them. They are generalizing the stock types for businesses. And here's why that is a problem. You see, the stock market, like any other market, grows by expanding their options. And just like in the, say, phone market, while there might be individual phones that are objectively better or worse, the two main types of smartphones, Apple and Android, cannot be categorized as universally better or worse because that depends upon the consumer. And the same logic applies to stocks, since there might be individual stocks that are better or worse than others. The two types are only good or bad for you depending on your business needs, goals, and capital. So now that we know that our goal is not to understand which stock is best, because let's face it, both of them are equally as useful in different scenarios, let's explore the exact differences between the two from the perspective of a businessman, starting with the most basic difference of all. What sets them apart? Now, I know we took a long time to get here, लेकिन भागने से पहले चलना सीखना होता है. But now that we are here, let me tell you about the main technical difference between the two kinds of stocks, that being the way they pay you back. First, growth stocks, since they're the most widely traded, widely offered, and the stock that you generally think of when thinking of trading, these kinds of stock offerings from companies like Amazon, Tesla, and India ke liye, things like Bajaj Finance or Britannia allow you to buy a subset of the business. In other words, a share or a stock that then grows in value as the business grows along with it. So if you bought stocks worth 1,000 rupees when the company was small, as the company grows, your 1,000 rupees will also keep increasing in value. And in most cases, there's basically no limit to how far that value can rise. By comparison, dividend stocks are like how you would traditionally think of buying a business where you buy a small percentage of a usually successful and stable business to claim a small portion of the profits after a set amount of time. And unlike growth stocks, these profits are not added to your stock's value but are paid to you directly in your bank account. That alone should highlight a few important differences in the way they can affect your portfolio. But before we get into that, let's also talk about how they work and how they behave. This is by far the most important thing to know when looking for stocks, because while you may understand the technical difference between the two stock types, जब तक आपको ये नहीं पता कि how they'll behave in the actual market and how they'll pay you back, you will lose money. So now that we know the importance, let's talk about how both of them work, starting with the way the two work financially. Now, as we mentioned, growth stocks are the kind that attach themselves to a company's value and rise alongside it, while dividends are the ones that allow you to become a regular owner of the company who gets a subset of the profits delivered to his door to do whatever. But on a more technical level, both stocks are basically buying a portion of a company or a business. The only difference is that when that company makes a profit, that profit is sent directly to the dividend stock owner. While in the case of a growth investor, those profits get invested back into the company so that it can grow. This means that dividend stocks pay you back regularly throughout your ownership, while growth stocks just sit around as their value soars higher and higher. This also highlights another difference. How exactly do they pay you back? Since the entire point of buying stocks is to make money, this is an understandably big difference. So, as we mentioned, dividend stocks give you material, spendable wealth directly into your wallet for you to use as you please. But in the case of a growth stock, your money basically stays attached to the company until and unless you decide to sell your stock. So in a way, dividends will pay you over a long period of time, while growth stocks will only pay you when you decide to get rid of the stock. But since that's the case, growth stocks have the upper hand in potential for profit. You see, because dividends keep paying you back, the original value of your investment only rises a tiny amount, even after years of ownership, while all the profits you make are kept out of the valuation. By comparison, a growth stock not only grows with a company as a whole, any profits you make through the stock get invested back into the stock, meaning that given enough time, the value of your stock can rise to an astronomical level, far more than the direct dividends you'd get paid with a similar dividend stock. But, as anyone who has ever tried business can tell you, with great potential comes great risk. The risk involved? You see, the same logic that makes growth stocks potentially attractive also makes them super risky. Because where a dividend stock will pay you back no matter what, and even if the company starts to flatline, you'd just be able to get out, while all the profits you made will be safe in your bank account. In the case of a growth stock, if you make a bad decision or the company goes under, not only will you lose your initial investment, you will also lose any profit you would have made over decades. And that finally brings us to the businessman's perspective. Now, all the things we have said up till now explain the differences, potential profits, and risks in two different stock approaches. But what does that mean for you as a businessman? आखिर सब सीख के कुछ करना भी तो है. And well, as it turns out, the answer, like most things in business, is to first know what you want. You see, if you're someone who is older or someone who wants a steady income to support their families or luxuries, the solution is obvious. You'll buy dividend stocks. This will generate a good cash flow since the profits from these stocks are generally tax-free, but will also give you a steady passive income that you can use to buy more stocks. Now that settles the case of retirees, but since most of us are young, aspiring business people, the answer is a little complicated. The first and more obvious scenario is that you're someone who has a day job to help pay the bills and is looking to grow your portfolio. In that case, growth stocks will be your friends because while they might bring a lot of risks, as long as you make good decisions and don't bank everything on them, by the time you retire, you'll have an incredible amount of money that you can cash in by selling those stocks. But if you're someone who actively trades stocks or has his own business that generates profits, the way to maximize growth might still be to own dividends, because that would allow you to invest the passive profits from your stocks into your business to generate even more profit. In this case, if your return on investment through your own business, also known as IRR or internal rate of return, is greater than what most stocks offer, then you'd be better off taking dividends to put back into your business to generate even greater profits. But the thing to remember in all those cases is to know that no one stock or one kind of stock alone will be enough on its own. So whatever you do, as long as you don't bank on one entity and keep a diverse portfolio, you will succeed. And that concludes the differences between dividend and growth stocks. I really hope you found this video helpful, you guys. And if you did and want to learn more, please feel free to subscribe to the channel and ring the bell icon. But before you click off, we have a question for you. What do you think is the better kind of stock for retirement? Please let us know what you think in the comments below. And well, on that note, we must say goodbye. I hope you enjoyed watching, and if you did, be sure to leave a like. With that, take care, and I'll see you guys next time.